Don't know me, I'm Don Miller. I'm the GIC Vice Chair for Programs. And the Global Interdependence Center is a neutral convener of dialogue. The headquarters is here in the Philadelphia Fed building. And so today we have something special. We have a debate. We have a debate on using technical analysis. So we have Bill Poole, who will give one perspective, an economist's perspective, and we have Katie Stockton, who will give a practitioner's perspective. And they're different, and we're looking forward to seeing how the views overlap, and especially where they don't overlap. So let me lay out the day. We have about 2 hours. We'll be in this room for 2 sessions. President Poole will go first, and Katie will follow. And we'll have some time for questions for both at the end. After that, there is lunch provided. It'll be over on the bridge. We have to go out and left, but we can direct you when we get to that point of the program. So let me introduce our speakers, and we can get started. So first, William Poole is a senior fellow at the Cato Institute, a distinguished scholar in residence at the University of Delaware, senior advisor to Merck Investments, and a special advisor to Market News International. He retired as president and CEO of the Federal Reserve Bank of St. Louis in March 2008. In that position, he served on the Federal Open Market Committee. During his 10 years at the Fed, he presented over 150 speeches on a wide variety of economic topics. Before joining the St. Louis Fed, he was the Herbert Goldberger Professor of Economics at Brown University. So we're certainly interested in his perspective as it pertains to financial markets. We also have Katie Stockton from BTIG. She provides technical analysis with a top-down approach using multiple indicators to help identify trends and short-term trading opportunities. Prior to joining BTIG in 2013, Katie served as the chief market technician at MKM Partners. Before MKM, she was a trader for Ulysses Management, which is a New York-based hedge fund. She's also served as a publishing analyst for the technical strategy group at Morgan Stanley. Her career began in 1997 in San Francisco, where she worked as a technical analyst for Witt Soundview. She is a CMT as well. So I think we have 2 good speakers. I think we'll hear some different perspectives. So without further ado, let me turn it over to Bill Poole to start us off.
Thank you. Well, as Don pointed out, when I was at the Federal Reserve Bank of St. Louis, I gave lots of speeches. I guess it totaled something like 150. And every speech began with a disclaimer. I was speaking for myself. I was not speaking for the Federal Reserve System. So there's my disclaimer. But I guess I would add something that Don would have no reason to know. Merton Miller, very important figure in the finance literature, was the chairman of my thesis committee. He got a Nobel Prize in 1990. Gene Fama received the Nobel Prize. He was, in part anyway, the founder of the efficient markets theory and school of thought. Gene and I were students together at Chicago. We lived in the same student housing building, and we used to babysit for each other's kids. So Gene got Nobel Prize in 2013. Okay, so listen at your own risk. So what is technical analysis? Well, we're going to hear more about it, but it's an attempt to extract predictive value for the investor from the history of stock prices and other prices in other speculative markets as well. And I've got some examples here, which I don't need to read because all of you can read. I think you can see this from the back, yes? Okay, so I'm going to argue that the attempts to predict the future, this is what technical analysis is all about. The effort is essentially unsupported by evidence and does not really work. And that economic theory tells us that it should not work. It ought not to be expected to work. Any investor success using this approach, I believe, is fundamentally due to other aspects of the investment strategy, not to extracting information from the past history of prices per se. I also believe that technical analysis has the potential to mislead investors, especially non-professional investors. It distracts investors from the key aspects of portfolio management. And I will discuss a couple of those from my perspective. Now, I'm going to use some data. Katie has some series also. I'm going to concentrate on the S&P 500 index. I'm going to use end-of-month values. And I was able to get easily off the internet from mid-1986 through September of 2015. S&P wanted me to lay out $2,000 to get a longer series, and I decided that wasn't really necessary for present purposes. Now, just an important point here, we should always work, we've got to be very careful about the statistical properties of the series we're working with. In the case of most data, we often use monthly averages. Monthly averages produce, just because of the averaging per se, produce serial dependence in the observations. And there are many other aspects, statistical aspects from the data that we use that need to be considered very carefully. So I believe that some of the purported success of technical analysis is simply a consequence of the way the data are constructed, and that the data can produce misleading results that are not genuine. Okay, so here's the S&P 500. I challenge hey, to find a pattern there. Now, these are changes. These are percent changes. Strictly speaking, these are first differences of the natural logarithm of the series. When you look at the level, and this is, of course, where the Dow theory came from, you can look at the level and you may think that you can find a pattern in it, but you make money off of changes. You don't make money off of the levels. You make money off the changes. Now, there are some characteristics here that are common to many of statistical series, first differences in different markets. There are periods where there seems to be relatively low variance, and there are periods of much heightened variance, and that's typical of these markets. That doesn't necessarily mean that you can make money off of that observation. For one thing, it's quite unpredictable as to when the period of heightened volatility will begin or when it will end. But let me emphasize, I challenge anybody to find a pattern there that would enable you to make money. Okay. Now, here's a version of the S&P 500. Find a pattern in that one. Here's another version of the S&P 500. That's the more familiar version. Those of you who know anything about the history will know that this version, there's something screwy about this one. Well, where did the one that I labeled S&P 500B come from? It's phony. It is indeed phony. But here's the way I constructed it. I took the first differences, the percentage changes, strictly speaking, the changes in the logarithm of the actual series, and I put them through a random number generator. So I got the changes all mixed up. The order is they're completely out of order. And then I added them together to produce the artificial series. But the artificial series has many characteristics when you look at it that are very much like the real series. very much like the real series. And if you were a chartist or technical analyst, you might well try to make something of this, even though I've just told you that this was put together by mixing up the percentage changes from the actual series. They're all out of order. I'm guessing, I don't know, I'd have to go back and identify. As you know, one of the biggest changes was the stock market crash in 1987. I haven't gone back, but I think that this is probably that October 1987 observation, or maybe it's this one, probably this one. I'm not sure. But this is the totally artificial series, and it has many characteristics like the real series. So here I just took some snapshots out of a couple of these series. Pick which one is phony and which one is real. I challenge anybody, and I don't even know because I forget what I did where. But they have very similar characteristics, even though one of them is clearly phony. Okay. Let's look at gold. Many technical analysts love to look at gold. So there's gold. That's the level. This is picked off the St. Louis Fed's website, Federal Reserve Economic Data. There's gold. There's first differences. Now the gold chart was daily observations. So these are daily observations, percentage change in the price of gold. I challenge anyone to find a pattern there that would allow you to make a good living or any profit at all. Here's another one. This is the US Euro exchange rate. Obviously a very important series, the exchange rate. But there's the first differences, percentage changes, again, daily data. So when you look at the data in the right way, they're really, the purported patterns that the technical analysts try to find in the data, those patterns aren't there. Now I want to talk about what I think is a very, very important issue that too few investors are aware of. This is the issue of fat tails. There are more observations out away from the mean, substantial distance from the mean, than there would be if the observations followed a normal distribution. This is a critically important issue for investors, much more important than trying to search for pattern in the data. So over the period that I used, the mean was a little below 0.6% change per month. Standard deviation 4.46. So look at the mean minus 2 standard deviations. That's minus 8.3. Normal distribution, you would expect to find with this many, 351 months, you would expect to find 8 observations of that size, that is minus 8.3% or smaller. In fact, in this series, there's 15, double, or almost double the number that you would get from a normal distribution. And look at mean minus 3 standard deviations. That would be a decline. Again, this is end of month to end of month. That's my sample. Mean minus 3 standard deviations is a decline of almost 13%. With a normal distribution, you should have about a third of an observation, or one way of looking at that is 1 observation in 90 years. I have 29 years, so just sort of multiply that by 3. You would expect to have 1 observation in 90 years. In fact, there were 3 in this period. Those declines are incredibly important to investors, and it's extremely misleading if investment advice is given on the basis of an assumption of normality. It is very misleading. Here's an example that I pulled off the internet. There's quite a few. And I don't know exactly the sample period or anything about this, but it illustrates the common observation. And incidentally, common observation from the work, especially of Gene Fama in the 50 years ago, or more maybe. So what you need to do is to look, so the green is a normal distribution. And it's very common in markets like this. Gold market, foreign exchange market, commodity market, bond market, all of them have the same characteristic. There are more small changes, close to zero, but the tails are high. And it doesn't show up so dramatically here. You have to sort of look for it. But here are the red observations. There's a lot more of them up there. And down at this end is also. In fact, this one, way back there, is probably, that may be the 1987 stock market crash. I'm not sure. But it's incredibly important that investors understand that these markets do not have a normal distribution for the changes. That's the kind of advice that professional investors should be giving to amateur investors. In my sample period, these are the big changes. I just listed them. And you'll recognize a lot of them. You can see that October 1987 1-month change, these are dated, it's dated 30 October. It must have been that 31 October was a weekend. So this was the last day of the month. So that month, the market dropped by over 24%. And that's the market average. That's the market average. Although that was a very odd circumstance, but there are quite a few others here that are pretty big, pretty big. And then there's some big winners here too. So if you take the average of these fat tail events, the declines and the average of the increases, the fat tail increases in my sample, you can see that the increases, the average is over 9% per month, not an annual rate, 9% per month. And on the declines, again, in my particular sample, 11%, not an annual rate, but 11% per month. That's what investors need to understand. For individual stocks, same thing happens. We get some horrendous changes. We've got the recent VW case. Stock is down by 1/3 or something like that. This is what investors need to understand. And this is why diversification is so terribly important. Texaco bankruptcy in 1987. It's really quite an interesting case if you want to understand. Texaco, before this case, was a AAA credit. It had bonds outstanding that were AAA. And it was a really screwy case, and I'll let you explore it if you're interested. It ended up in bankruptcy court. Penn Central bankruptcy in 1971. Penn Central had a large amount of commercial paper outstanding. This doesn't sound like very much today, but prime-rated commercial paper, $80 million, which in 1971 was a lot of money. So Penn Central bankruptcy was a consequence, basically, of a political dispute between the Nixon administration and the Democrats that controlled Congress. Penn Central thought, and the market anticipated, that there would be additional subsidies to the railroad for moving Vietnam War cargo. It was all held up, and they went into bankruptcy. Another very odd case. So these are the critical things. And talking about technical analysis simply is talking about the wrong subject. Now I want to talk about continuity. Many investment models assume not only normality, but they assume continuity. That is, if the price is going to go from 100 to 80, the models assume that the price goes down a penny at a time, not that it jumps discretely. But in fact, the prices move in discrete jumps, like the VW case that we just saw. The portfolio insurance model, which was part of what seemed to have been responsible for the 1987 stock market crash, that model assumes continuous random fluctuation using a model that is really derived from natural sciences. The model has Brownian motion of molecules, gas molecules. That's the basic structure of the model. So the gas molecules do move continuously. No oxygen molecule in this room, I don't think, is going to suddenly jump out there. If it's going to go out there, it's going to move in small increments. The option pricing model also assumes continuity and assumes normality. Now, the option pricing model has been terribly useful, in part because there is no adequate substitute. So prices move in discontinuous jumps, and that's very important to understand. It's very important to understand when you're putting in stop loss orders, for example, that the market price can jump in a discontinuous way and turn your stop loss order into something that you didn't really think you wanted. Okay, so why do the inventors of these schemes not maintain secrecy and trade off of them? If they're so good at forecasting, in fact, we know that there are hedge funds that have highly proprietary schemes. And one of the things that's been quite interesting in recent years is that hedge funds have been using larger and larger computers. They have moved the base of the operation closer and closer to the trading floor to reduce the time it takes for the signal to go down the cable to execute the order or the information. And more operations are being programmed to do that kind of thing. But the hedge funds do not advertise. They don't advertise their models. They want to keep them as proprietary models. It's the same thing that Coca-Cola does. Coca-Cola has maintained secrecy over its formula since it was invented back in the 19th century. And then whenever these things get programmed, when they're successful, large numbers of people jump on the bandwagon and bid the profitability out of the scheme. So you ought not to expect that any of these schemes that are based on attempts to extract useful information, profitable information from the history of prices per se, you ought not to expect that they will work. There's this famous Warren Buffett quote. Probably many of you are familiar with it. Buffett is the most successful investor in the United States over the past 50 years, maybe longer, maybe of all time in the United States. So it's worth paying attention to Buffett's advice. Okay, so we're going to have the discussion in a few minutes, and I'll give Katie the intro.
Okay, the pointer. Thank you everyone for being here. Let's see if I can figure this out here. Get back to the main screen. So I'm honored to be here in the presence of Bill, and despite his take on technical research, it really is an honor. So thank you for having me, of course. And as y'all know, my name is Katie Stockton. I do technical research, and I've been doing this for now about 18 years, I'm sorry to say. And my background is really, I guess I got into it because I had a mentor who, his name is Tom Dorsey, if you all are familiar, and he does the point and figure charts, the X's and O's, which is one that's really tough for people to grasp in general. That's why I kind of got away from it, because I am a sell-side technician now at the end of the day. So not only do I have to believe in what I'm doing, I have to also be able to talk about it to our clients. So you sit down with the X's and O's, and I get a lot of tic-tac-toe references, and it just doesn't go over well. But I've been doing this for a long time. I love what I do. I do feel like technical analysis gets a bad name, and I think a lot of it is because of the jargon. Hence here, the squirrel sitting on clown shoulder pattern. All of this is highly publicized, even the death cross and things like that, things that have the catchy names, make it seem a little bit less academic, I think, than it really is. I'm sort of a math nerd, or at least I was, and because of that, my toolbox is really sort of indicator based, and these are all primarily price based indicators. I sort of classify them three ways: support and resistance. To me, that's the most important concept of technical research. Three classes: trend following, overbought, oversold, and relative strength indicators, and then market internal measures, which are really what you read a lot about. That would be your breadth, your leadership, your sentiment, and also volume, which really isn't a big input for me. And then, of course, I break these things out and turn them into sort of workable tools that you have listed there. Stochastics are something you're familiar with, I'm sure. MACD, moving averages, things like that. So all of these things come together for me in a complete picture for the markets that I analyze, and my takeaways sometimes are wrong, certainly, sometimes are right, but I do think the process can add value, if not for its sort of predictive value in opportunistic trading, certainly from a risk management perspective. So we'll go through some slides here. So this here, and I'm not here to make a market call by any stretch, but I wanted to show some charts that I think are sort of relevant to the conversation. Support and resistance, like I said, a very important concept for us. Support being an area of potential buying pressure, and resistance an area of potential selling pressure. Note here the levels that have been important for both the Euro Stoxx 600 in the top there and the S&P 500 in the bottom there. It would be tough to argue against the importance of support and resistance when you have a so-called successful test of support here, and where is my pointer? Here we go, and resistance up here. And also another takeaway from this would be breakouts do matter. So when you relieve the market of the potential selling pressure or the selling pressure that exists at a certain level for whatever reason, then sometimes it becomes sort of off to the races, which indeed is what happened with the S&P 500 in early 2013. The way this sort of fits in with my current view is if we did see some follow through on the upside in equities now, a lot of major indices, including the Euro Stoxx 600, would be at new sort of multi-year highs. And that to me would be a good thing just from a momentum standpoint. And momentum is obviously very important these days, however you measure it. I tend to measure it differently, I think, than Bill does, but I do think it's an important tool. So technical analysis does have some roots. Going back to, I think it really was one of the first disciplines in analyzing any kind of market, really. Back in Japan, they created something called the candlestick charts, and I won't go through all the details here. This is from the Market Technicians Association, which I'm involved in. But essentially, they saw value in identifying price trends early on, and it's obviously been a longstanding discipline And essentially, that's where the foundations of sort of market psychology and now behavioral finance came from. So we really highly value the history of our discipline and sort of the visual price pattern recognition that has been developed over the years. The MTA has sort of drafted a new definition of technical analysis, I think in part to help do away with its perception as being something that's sort of voodoo or something like that. And you can read it there in the underline here. But the emphasis is really on technical analysis being a complementary discipline, not something that's to be used as a standalone, but rather to enhance or otherwise what you're doing in terms of your fundamental research or macroeconomic research. So it does emphasize supply and demand, which therein comes that support and resistance again. And these slides will be available on the website, I believe, so you could always refer back to them if you're interested in reading. I should have used a bigger font like you did. A little too much information maybe. But you can't get through a presentation like this without citing and referencing Andrew Lo. He's a professor at MIT and very well respected in his field and also in the field of technical analysis. He's what I would consider to be a convert, was very much skeptical and a big doubter of technical analysis, but went on to write sort of the foundational paper, academic paper, to support it. And I've just underlined sort of takeaways from the academic research that I present here that do favor technical research. It's not something I've never been one to, sort of dig into the statistics behind these things. I'm certainly not really qualified to do that. And yet I trust these guys. They look smart. So especially in that picture, right? He knows what he's talking about, definitely. And so some more excerpts from his paper. Eliminating noise, of course, some price movements are significant. They contribute to the formation of a specific pattern, and others are merely random. And I think that's important where indeed you're acknowledging that there is some randomness. I would never argue against that, but that the whole complete picture isn't entirely random. The market does move in trends. There are existing patterns. And here comes the scrutiny, over technical analysis as voodoo. We all have seen the book A Random Walk Down Wall Street, and probably have all read that here. And then finally, academic backing. Really, there are a lot of studies out there that do back technical analysis, and we'll go through a couple of them here, but essentially that there is some predictive value, whether you're using a momentum-based tool or as otherwise. Anything that's price-based can actually have some predictive value. And, sort of to bring up the voodoo side of things, I am glad actually to be able to bring up a gentleman named Tom DeMark, who I believe he was nominated for a Nobel Prize but didn't quite make it. But he's a real technician, and a lot of his work has a basis in Fibonacci sequence, which is sort of a highly respected mathematical tool and the golden ratio, if you will. Now, Tom DeMark has created a series of indicators. I want to say there's 40 of them out there, and he's one of those guys that I think he keeps some of them secret so that he can have his huge house in Arizona, but but the rest of them he's willing to share with us, and we pay for it, what have you. But essentially, he's developed, this is one of his indicators where you see the numbers sort of floating above and below the price bars. And when you tend to see the 13s and also the 9s, not accidentally related to the Fibonacci ratios, you can see here that it often ends up being an inflection point. When it's below the price bar, that's when you get often sort of climactic lows and vice versa. There are very few technical indicators, as you can imagine, that are coincident or leading indicators. We wish there were more of those, but of course we're using historical data, so they're often going to be lagging because we're following momentum. So let's say when you have a breakout above the 50-day moving average, well, the low is already in place. And oftentimes I find that the DeMark indicators can help me identify that low much closer to it, or that high much closer to it. So this is just one example of one of those tools that, it's not a black box, but certainly he keeps it pretty close to the vest. And for me, from my perspective, I'm here to talk about technicals as a practitioner. certainly not from solely an academic standpoint. But really, I've been doing it for 18 years, and my clients pay me for it. We have, very good readership on our technical product. I have a couple samples of our research out there. In fact, mine, of our group of, I'd say, 15 analysts, of which 12 are fundamental, mine has among the highest readership. Our clients are primarily hedge funds and mutual funds. Very smart people, well-respected professionals. There is, of course, sort of the audience out there that's the retail investor, and they eat this stuff up too. And I guess you're fearful that they're being misleaded by it. But to me, I think it can add value, especially from that risk management standpoint, if you use it correctly. We've helped identify correction lows for the S&P 500 in recent years. Our tools can help us do that, identify when we're in that kind of fat tail type of environment like we were at the August low, to be able to step in front of that and say, you know what, this is actually overdone, regardless of not having said, okay, well, we're going to be down 12% in 4 days or what have you, but rather to say, okay, here we are, let's take a step back and regroup and know that it's safe to get back in. So my indicators are quite good at that. At least giving us some confidence in knowing where the risk may be in terms of where there is the next support or resistance or what have you. Of course, the media coverage, it's really sort of a blessing and a curse. I've had a lot of publicity because of what I do. I think in part it's because I'm sort of a generalist and I can talk about just about anything. So there is that. But I do think that people want to hear about it because things do move in trends, and it's often a source of theme-based investing. So, for example, if the transports started losing relative strength, somebody wants to know about that. And I think the media coverage does sometimes sensationalize it, and sometimes highlights things like the Hindenburg omen, which is just too obscure to even go into for this conversation. But really, at the end of the day, I think it's because there is an interest in these tools on Main Street, and for good reason. So this year, a white paper was published, or an academic paper was published, based on CNBC's Talking Numbers, which is just a program that pits fundamental and technical analysts against each other. And so I found this awesome picture here with me smiling, the fundamental research analyst sort of frowning there, and then the classy headline of too much junk in the trunk. So God only knows what we were talking about at the time, right? So over a period, I believe, of 4 years or so, they analyzed the recommendations, considering time frame and things like that. And it gave them a forum to sort of say, well, what's working here? Are these calls making any sense? And I wouldn't show these slides, of course, unless they made sense. So the results really favored technical analysis. And my design here is not to say fundamental analysis doesn't work, but the results were very compelling, saying that not only was the technical call just more right, it was also that the strong buy really should have been the strongest buy, hold, sell, strong sell. And you can see from the fundamental recommendations here, it's really that not only did the sells outperform dramatically, but really it was a mishmash otherwise, with a lot more volatility and just unreliable returns, I guess, if you will, if you were to actually have invested on their ideas. By no means that I'm saying go to watch Talking Numbers and take those recommendations and invest using them, but certainly over the past few years you would have been better off taking the technical recommendations over the fundamental recommendations. Really, at the end of the day, you want to combine both, of course. So we have to address the efficient market hypothesis. I'm not here to dispel that, but to say maybe we should consider Andrew Lowe's AMH, which is the adaptive markets hypothesis. It basically is what I see as sort of the merger of the EMH and behavioral finance, where you're taking a look at sort of the psychology behind the market participants and considering that as you consider the economic viability of the moves and what have you. So I think that's sort of a consideration here. Behavioral finance is really catching on, and for good reason, because I think what happens, there's really just a gap between what is happening sometimes and what should be happening based on the fundamental data that's available to us. I tend to look at the charts with more of a short to intermediate term perspective, and I do that in part because I feel like the long-term drivers of the trends are certainly economic and fundamental in nature, but sometimes they need folks to help fill in the blanks. So I often find that I'm holding my clients' hands through those corrective phases, which do tend to be highly volatile and somewhat painful for the long-oriented types. So this, I think, is a nice sort of alternative way to look at the efficient markets as being slightly inefficient at times. And I have a nice quote here from Kahneman, who won the 2002 Nobel Prize and really is known for sort of his background with behavioral finance. This is a friend of mine, Dave Lundgren. He helps manage a technically driven mutual fund, of which there are very few out there. But he's just a smart guy, so I wanted to cite him. He's really the true practitioner as I see it. I'm just one of those analysts who talks all the time, and I don't unfortunately get to do what I talk about because compliance won't let me. So I really would rely more on him than me. And he just talks about sort of, again, another version of EMH where he calls it the efficiently random market hypothesis, where the longer term trends are not random, but once you get into the very sort of near term, sort of go fractally down to the 60-minute bar charts or what have you, that's where you get the randomness in terms of the flows. And I think that he's got a pretty good point there. But of course, trends do exist. And my goal is to identify trends just using price or yield in this case. So to me, when you see a trend channel that is this reliable, it's hard to deny that these trends exist, and it will give us a sense, of course, of when there's a shift likely underway. For example, if we were to clear 3% in the 10-year Treasury, that to me would be significant because it would mark a move outside of this trend channel, which I think would be something that we could talk about certainly. Until then, we can say, well, maybe there's a loss of downside momentum within this channel, certainly, because the character of the move has changed. I mean, note back here, the up moves in the 10-year were much more, or 10-year yield were much more sharp and severe than they have been in more recent years. So perhaps there is some kind of change underway in trend, but it's a bit too early to make that call, certainly. Oh, and this is just going back to Dave Lundgren's group. This is one of the funds that they manage, and it won the best fund over 3 years for global multi-cap growth funds, just an award given by Lipper in the past year. So these guys are doing something right. They also do take in fundamental inputs and they take in macro inputs, but their primary driving sort of factor is technical research. And they, I know their style very well. They really are long-term trend followers. So what I help them do, for example, is to look for counter trend opportunities on the short term within stocks that are in long-term uptrends. So I have some scan work that I do for them. I look for oversold conditions based on my stochastics or based on the DeMark indicators and try to find those opportunities where a name has pulled back and yet still has not reversed its long-term uptrend. And they have had obviously very good success with that strategy, and they're very well respected. I can only imagine that funds like this will probably expand and grow, and certainly they've been successful with them. And, at this point, it has become so widely publicized technical research that really, I feel like you're at a disadvantage if you don't know about it, if you don't know certain things. Certainly, I couldn't get through any kind of investment approach without looking at a chart because I tend to be more visual in nature. I think if you are visual in nature, certainly just to start familiarizing yourself with the charts and what works and what doesn't. There is no right answer except what's right for you and your trading style, of course. But just the S&P 500 as an example with the 200-day moving average and acting as a support and resistance level where sort of breakdowns, breakouts are actually pretty impactful. I think maybe in part the 200-day moving average is important because so many people watch it. Maybe it is self-fulfilling. I mean, it's a historical look at where it's been, and yet at the same time, it does act as support and resistance. And if that's just because so many people are watching it, so be it. I mean, we still have to know where it is then, right? So we've seen it act as support several times, just brief dips below. I always look for breakdowns to be confirmed on a consecutive weekly closing basis. That's where you avoid whipsaws. And here, of course, was where you got the breakdown, and back here was the last real breakout. And I dug this one up. Actually, I had to give my associate credit. He was looking up, academic papers, and he found a couple from Bill's old sort of stomping ground at the Federal Reserve of St. Louis. And I guess this was after you retired, so unrelated to your stint there. But there's been a couple of papers out of the Fed Reserve banks that do sort of, I guess, put in their vote for technical indicators, for technical research, and using a variety of statistical data and factors. And I think that just is one more sort of vote in favor of it. These are folks that tend to be more fundamental, more macro oriented, and yet they're keeping an open mind to the technical tools that work, and really, in part, I think, driven by this push for the behavioral finance. Notice the publishing date, I think it was 2010 and 2011, perhaps, for these papers. Finally, when all else fails, right? We look for the black swan formation. Here's, I don't know, some of you, if you're in the institutional sides of things, you've probably seen this chart already. It went around, and what I'm trying to show here is really, it is very visual. Of course, this is not a big pattern for me, but it's really something where it's not all about statistical sort of analysis of different returns, but rather trying to identify setups that work and setups that don't tend to work. Gaps are certainly an issue. I mean, when you have a news-driven gap, I have to go like this sometimes too, but I think that charts have a way or a place in order to help you manage risk of those types of gaps, where you can see something structurally unfolding at times in advance, and certainly you'd be amazed by how many of these signals pop up right on the gap down day and end up being an opportunity as opposed to something that's, something like the worst is over, right? And it is an art, it's not a science. And I think some folks make the mistake of trying to make it too academic, and these papers, they're addressing one element of technical research. We all do it our own way. We all have different approaches to it. And, what works for you, again, it is what works best. And I would say that I'm sell side, so I go around and talk about it all the time and talk about what works for me. And yet I would say there's probably a whole lot of rich people that are keeping it close to themselves and not telling us what they're doing. Not Warren Buffett, of course, but there are a lot of folks out here that are using technical research with a lot of success, and I get to meet a lot of them at the meetings I attend, and I think we're all passionate about the tools that can take any of that gray area out of the market, make it more of a yes or no. Does it have positive momentum? Is it on a MACD buy or sell signal? Those types of things where it can take any of the guesswork out of the market. I think that's really a gift of these sort of mathematically driven indicators that I use. And then pattern recognition. It is very difficult to program any kind of pattern recognition. You can certainly program moving average crossovers. You can program a lot of the indicators, and I've worked a lot on this. But in terms of trying to program a triangle formation, it's very, very difficult. I've seen a couple of firms come close to it. There's a firm called IDO Search. It's EIDO. They've been doing a lot of work looking at percentage-based changes and trying to find analogs over history, and they've come up with some really, really neat information. And that's the closest that I think I've seen to it. You can find, some price patterns that, flags or what have you that really set up pretty interestingly through them. But it's a very advanced piece of software, and I think it'll take some time to catch on. And I'll end with a chart of the S&P 500 because it seems to be on everyone's minds constantly, just to give you a sense of how I look at the world and how I employ the indicators that you saw there in my technical toolbox. We did have, the S&P 500. This is as of Wednesday, but we had the S&P 500 clear its sort of psychologically significant 2,000 level, and these levels do matter. As soon as we hit it on an intraday basis, it just took off, right? So that's not accidental. It's because momentum sort of picks up when these levels are cleared. And now that we're above 2,000, I think that a bullish call is the right call. People say, oh gosh, but are we overbought? Well, overbought and oversold are misused terms. An overbought, oversold measure is typically really a gauge of momentum. So this is the stochastic oscillator here. Notice it kind of goes between 0 and 100. When it gets above 80% there, it's so-called overbought. And yet it just doesn't matter. In fact, it's more reflective of a strong or strengthening trend until it comes back below. Let's see if I can show you an example here. So that's your sell signal, is when you come right back below. And usually it has like maybe a 2-day lag to it. So I think it's pretty helpful to have that as an enhancement of what you're seeing on a short-term basis. This, of course, is very short-term work. And then what we can do to gauge upside potential is to look for areas of resistance. And of course, here, because the S&P 500 traded there for a long period of time, this would be more relevant, of course, for a stock than an actual index, but this is for example purposes. Because it traded there for a long time, there is, of course, potential supply in that trading area. So the next resistance ranges in that sort of 2,100 level, and we'll have to see how it acts there. If it can plow through it, that's a very, very strong market. Not only because we got through a resistance for the S&P 500, because you have to believe that that kind of move here is probably associated with some major moves overseas. And there are quite a few major sort of world equity indices that are really on the verge of new sort of multi-year, multi-decade, or even all-time highs. That would be significant, like that Euro Stoxx 600 index for one, Nikkei 225 for another. So if you were to see new highs in the US, it would be really sort of a global vote in favor of the secular bull market and its continuation. And then the last indicator here that I'll tell you about is the MACD. Of course, it's a moving average based indicator. And when you have the blue above the red, that's your buy signal. The red is just a signal generating moving average. So it's like a moving average of a spread of moving averages. And essentially, it just gives you a sense of it helps you eliminate noise, right? So it gives you a sense of what the prevailing trend is. It also gives you a sense of sort of divergences. This wasn't really an obvious positive divergence for the S&P 500, but certainly we had the same setup. And for example, the Russell 2000 index had a lower low in price terms here, but a higher low in momentum terms. And that's where you get sort of your feel for the marketplace. We all know that sentiment was horrible at both the August low and also the September low. So to have some kind of valid gauge of sentiment can also be very helpful. I would argue the VIX is not the most valid gauge of sentiment, but rather there's some great tools. There's one on CNNmoney.com, I think, has one called the Fear and Greed Index, and it showed fear as having been extremely elevated, and that was based on 7 factors. It incorporates price momentum, but also junk bond demand, and the VIX is included in there, but it has a number of factors that I think are pretty relevant in terms of giving a transactional gauge of sentiment. So with all that taken together, we can get a market bias and help people position. But I'd say even more importantly, from a risk management standpoint, we can help people understand, what the downside is if indeed we're, setting up for a more sustained down move. And my advice right now to folks is to, just have your tight stop loss essentially below the August and or September low, depending which is lower, on a consecutive daily closing basis. So that's not giving the market a lot of room, but I'm not really willing to give it a lot of room here. So that's really my takeaway there, and hopefully I didn't gloss over those too much, but you have all the information on their website. So I think we'll take some questions.
Yeah, thank you, Katie, and please join me in thanking both of our panelists. Bill and Katie, if you take the blue table here, I think we'll take some audience questions.
So we're gonna all sit up there.
Okay, do you need this one?
You can have that.
Oh, cool.
I can look over your shoulder if I need it.
Okay, deal. I'll definitely get a picture.
Okay. No, so we're supposed to comment, is that the idea? On each other's presentation?
How
Or do you
about
get
a
questions?
2-minute comment from each, if you have anything to say
Okay.
Where's this?
in reference to
That's you.
other presentations, then we'll do some
Okay.
questions.
I'll see if I can keep my comments to 2 minutes. First of all, notice that she did not present any charts of first differences, which I think is where you make money. Her chart of the trend for the 10-year Treasury was interesting because she did not show the chart from 1960 to 1980, for example, that had the trend going the other direction.
That's as
But
much as I
perhaps the
could
most,
fit. As much as I could fit on the page.
well, you had more pages available. But here's the most important point. Have you kept a record of your calls? And have you analyzed statistically how accurate those calls have been, how much money people would have made? Now, the reason I want to emphasize that point, as people, we look for evidence to support our actions. If you think about taking a drug, a medicine, you'd like to know that the FDA has tested it and that it is safe and effective. In fact, we have an elaborate government process to do that. So every investor ought to be asking for the record of success of the technical analysts. And you don't ordinarily see it. There's a somewhat related observation, which is that index funds routinely do better than actively managed mutual funds, year in and year out. The actively managed funds are working on all sorts of information, technical and fundamental, and the index funds routinely beat the actively managed funds. So I would challenge Kate to present the evidence, show me that it works.
Okay, so as a technician and a sell-side technician at that, I sort of have the luxury of not having a portfolio to manage. And indeed, portfolio management is different than technical analysis. As you heard in my presentation, I don't advocate using technicals alone. I think it's a complementary discipline. And in doing so, I think it would actually be incorrect to say we can just make a technical portfolio and not have those inputs. And indeed, when I make recommendations, like in the Stockton on Stocks note over there, those are purely technical, and my clients know it. And sometimes they work, sometimes they don't. I do have a track record for that Stockton on Stocks chart of the week recommendation, and I share it with clients who ask me for it. And it's better than 50%, thank goodness. But the problem with doing that, it's very unscientific, just like technicals is really an art, because I don't close out the positions. So I give a bias, but my follow-up is not there because that's not a valuable use of my time or, valuable to my clients. My clients want to know, what do I think now? They don't need to know that I'm closing out my position, my short and coach from March, and that's not interesting to them. So I depend heavily on a feedback loop from my clients, the feedback that I receive from them. And if they keep coming back for more, that makes me feel like I'm doing something right. And also the feedback loop from our trading desk of 100 people. So I rely heavily on that. It's not scientific, of course, but I don't think it should be for my position. But I'm not here to really defend myself as much as I'm here to defend the discipline as a whole. I think, again, it's all in how you use it, but that it can be something that adds to your process.
So before we go to audience questions, I have a few as moderator. First, for Bill, your charts are mainly monthly frequency. Would you be willing to consider that a frequency that's different, say daily, weekly, intraday, could have different properties in this type of context?
Sure. understand that I am not a finance guy, and I suspect, but I don't know, that there's been a lot of research on intraday fluctuations, and I don't know to what, where that takes you. I don't know. I know that there are some big funds that are operating, but they're operating on stuff like this, but they're operating primarily on what you would call an arbitrage principle, and not on a projection from a chartist perspective.
You mean like market neutral? Is that
I'm sorry?
like a market neutral type of bias?
No, what I'm saying is that, what I understand about this is that that market, well, after all, what market makers do is to make a market in a given security, and they profit off the spread. So they are buying low and selling high, and they're making the market, and they simply manage their inventory to be sure that they're not too exposed, but they're making the market, and they are profiting off that spread. That's a type of arbitrage, if you will. It's a very important and useful function, and I don't deny that that exists. Of course it exists, and it's profitable. But that's not what we're talking about here. What the technical analysts are promising is that you can identify from the chart that there's an opportunity to make beaucoup bucks by buying, or avoid beaucoup losses by selling. That's what I am challenging.
Katie, would you agree that that's what technical analysis do most of the time?
Some do, certainly some do. And I think that that's where the whole media situation comes in, where the people that take a stage and promote their analysis with sort of that sensational beaucoup bucks or whatever, those aren't, to me, the true technical research analysts. The ones that I know are very disciplined and systematic in their approach. They're not sensational. They do not use the jargon that gives us a bad name, and I think they generally have a great foundation to what they're doing, whether it's statistical or visual simply. So I'd say that's not the crowd of technicians that I run with, and hopefully I don't have that perception myself. But really, it's as a risk management tool is probably the value that I think people need to promote more, certainly, to dispel that a little bit.
Bill, another question. If there isn't a pattern on a certain chart, could there be patterns between different charts? So I'd imagine the S&P and the Dow Jones Industrial Average and the NASDAQ day to day would be correlated. So could there be correlations across indices, across different charts that might be useful? Say you had two of the three do something and one not. Would that be information?
Well, I think the answer is that it obviously could be. I saw a note on the Bloomberg website that there seems to be some leadership from the Asian market to the U.S. market relatively recently. And I haven't looked at the nature of that statistical analysis. I would want to say that you would have to be very careful that you had enough observations, that that wasn't simply a temporary or anomalous situation. So that's really my point, that it just seems to me that the technical analysis. I want to say something about the pattern. You've made some interesting comments about pattern recognition. In fact, when I was putting this lecture together, one of the early comments I was going to make was, any one of you with a good imagination, that's probably true of anybody in this room, and a chart and a computer will be able to create a pattern. The question is, does that pattern have any validity? Could you test it on other periods? Could you test it on the gold market if you've identified it in the stock market? See, these markets all have a common characteristic. They are atomistic. There is continuous trading, large volumes. They are all storable commodities. You can store a share of stock between now and the future. That's true of the wheat market and the corn market. It's true of foreign exchange market. So these markets all have common characteristics, very different from the housing market, by the way, completely different from the housing market. So these markets have some common characteristics. And if you identify a pattern in the US market for a certain period of time, I would challenge you to see if it works on markets abroad, on other speculative markets. The problem is that there is no, and I want to emphasize, no economic theory that tells you that this ought to work. And therefore, you ought to be very cautious about hanging your hat on a scheme where there's no theory that says it should work, and where the testing is decidedly incomplete. It's harmful, potentially. It's harmful to your financial wealth. That's my point.
Could I address that? So, I mean, I would say that the theory comes from behavioral finance. I think that's where the theory comes from. Unfortunately, it is harder to understand people's emotions and how the market affects their emotions. So it's a newer sort of science, and certainly I'm excited to see where it's taken. But price patterns are universal. Anything that has liquidity should adhere to the properties of these price patterns, and I'd say it's even more prevalent in commodities and currencies, which tend to be a bit more pure in terms of their supply-demand relationship than your average stock, which has a bit more of the headline risk. So these price patterns, like I said, we don't have that many tools out there to identify them in a computerized fashion. IDO search being probably the best one that I know, but you could take an IDO search using that discipline that you use where you're looking at the day-to-day or month-to-month percent change and look for that similar property in the S&P and gold and across asset classes, across time frames too. And you can come up with some interesting testable, statistically significant results. And it's all ranked and everything. Unfortunately, you have to pay a whole lot for that service. But I guess, my point is that really, again, it's very visual. And, that's where we can add value as technical analysts. I would encourage you all just to hopefully prove my point that these things work, to keep an eye on currencies in the near term, because if you look at the euro dollar, currently it's been what I call wound up or coiled up in a triangle formation, which really just reflects a sort of a decreasing swings in either direction, less and less volatility, but it tends to precede a massive spike in volatility. The triangle itself doesn't give you a great sense of a directional bias. I would say more often than not, you see the primary trend resolve in the same direction, and yet I have a feeling the opposite will occur here, where you're actually going to see the euro break out against the dollar in very dramatic fashion in the very near term.
Make a comment about behavioral finance. Of course, technical analysis long predates behavioral finance. And the thing about behavioral finance is that it does provide a lot of insight into the behavior of individuals. A lot of insight into the behavior of individuals. But I have not seen, good studies that show that it provides insight into the behavior of market prices. And as an economist, I wouldn't expect it to, because I would expect that the biases in the illogical behavior that is uncovered in behavioral finance can be offset by the smart money that is going the other direction and that basically is responsible for the pricing in these markets.
One more question, Bill. Would you accept the absence of a pattern as information here? In other words, if I made a statement like markets tend not to make V bottoms, or
I'm sorry,
technical
the markets what?
tend not to make sharp V bottoms, would you accept a statement of that? So it's an absence of a pattern. In other words, technical damage takes some time to repair. If I said that, would that be acceptable, given it's an absence of a pattern that could provide some
Well,
information?
the charts that I put out with the first differences did have some common characteristics. As I pointed to, there are periods of heightened volatility and periods when the market is quiet. It's almost as though those periods of heightened volatility are like a seismograph where an earthquake is struck and the seismograph is going every which way, and maybe you've seen some of those charts. And then the ground is still, or mostly still. In California, you're always picking up some little wiggles. So that's what seems to happen. But it doesn't help you. It doesn't help you unless you have a good idea of the conditions under which the heightened volatility will start or the heightened volatility will end. And if you take our actual experience, I mean, the financial crisis is a really good example. Take a look at the staff material prepared for the FOMC meeting in October 2008. That staff material was prepared the week before. And by the time of the meeting, it was completely out of date because Lehman declared bankruptcy on Sunday night. On Tuesday, the Fed bailed out AIG. And so the staff material was clueless, absolutely clueless. But so were most of the rest of us.
I mean,
Could I ask Katie here, you could have said something. So Katie, when you get a surprise, what would you do?
well, I react, or else, right? For me, I just try not to get married to a call. This is me trying to identify my own behavioral tendencies, right? So when you do get a gap down, you certainly can't control that. No one can, but you can react to it in an appropriate fashion. And for me, if I do see a gap down or even a gap up, you look for signs of exhaustion in your indicators. And when enough of them line up to say, okay, this is over, this is done, whatever the driving force may be, that's when I feel more comfortable making a call from it. So there's a lot of, in this sort of environment that we've had over the past couple of months in U.S. equities, there's been a lot of me saying, okay, well, this is how I feel about it. But if this happens, I'm not going to be a hero. I don't need to step in front of it. Whereas, the rest of the year, it was more of an orderly type of call that I was making. But I do want to highlight that Bill keeps referring to common characteristics. And that's really all we're trying to identify are common characteristics from the charts. And if we can do that with some level of success, I think we add value. Technicians, I think largely, and again, I can't provide any statistically significant data to say that or to support this, but I would say technicians generally did better in 2008 than your average fundamental research analyst. I think they knew at what point that they just needed to get out of the market or be more short, even if they didn't get within percentage points of the high. I think in general they did much better, and that was an environment that really saw a lot of sort of influx of CMT candidates, which is like our version of the CFA, because people said, well, geez, like we need to manage the risk of this type of move. And, even if we can't manage the risk of the 3-day gap down, certainly we can know when the risks are heightened of something that's more prolonged.
Let's take some audience questions. If we can. We have some microphones that will come around so we can all hear.
Good afternoon. Don, I read your stuff regularly. Thank you for being here today. And Katie, I thought you gave a good presentation.
Thank you.
But I'll tell you, when I came out of my academic training, I was very skeptical of the technical analysis. Still somewhat understand there's some limits to it quite a bit and do not follow it that closely all the time. But I will say a technical analyst pointed out about 15 years ago to me, before it became a big news item, that there was some mispricing, say, in how international mutual funds were being traded because they would stay open. You could trade those at 4 o'clock and the foreign markets closed earlier. And technical analysts looking at historical data, which I was taught not to look at because it had no meaning, actually were the ones that discovered some of those patterns and brought it to the attention so that could be rectified. I also find interesting people like Katie always, I think they're some of the biggest readers of things like A Random Walk Down Wall Street, and Nassim Taleb is probably most read by people who he attacks in his book. So I think we're always looking to get better, which is interesting. Bill, my question is, the standard deviation is big and important for investing. It's also really big for financial planning. So we help a lot of our clients with, say, retirement planning. And so it's not just about the returns that you're going to get, it's about how those returns evolve over time. Because the distribution, when you're taking distributions from a portfolio, the path really matters. You're taking distributions in a down market. So we have some ways that we correct for that when we do financial planning. We run our Monte Carlo simulations. But do you have any recommendations about how you would correct and deal with that? Because obviously everybody needs to plan for their retirement. And that problem with it not being a standard distribution is well known. How do you correct for that and deal with that?
Okay. Well, one thing that you have to do for sure, is to be aware of the frequency with which these large changes do occur, and not be panicked by them. If you're doing any sort of formal risk analysis, you can't do it with a normal distribution. You're fooling yourself. You're making a mistake. I guess I don't know what else to say. Most of these big changes up and down, particularly down, but wash out after a while. There's a big literature. I'm not a statistician, and I haven't looked at it recently, but there's a big issue about whether for many of these series, whether there is a tendency to return to a trend, or whether it's a pure random walk. A random walk never returns to a trend. So if you start flipping a coin and have your whole household flipping coins, and you add $1 every time there's a heads and a tails, you take away $1, and you start from some point, that series will wander indefinitely far away. And there's no tendency to return to your starting point. So there's a big literature about whether some of these series have a tendency to return or whether they're pure random walks. Now, where I come out on that is that for practical investment purposes, the series are close enough to being random walks. If there's a tendency to return, it's very slow and long run. There was a book some years ago, and I have it somewhere, I've lost it, by Sidney Homer on the history of interest rates. And some of you may be familiar with this book. And Homer argues from evidence obtained back in ancient Egypt and Babylonia that interest rates back then were not all that different from what they are now. Now, he wrote before the days of zero Fed funds rate. And so when you look at an interest rate series, given that history, the probability that an interest rate of 6% in ancient Babylonia would still be about 6% today, that probability is infinitesimally small if you had a true random walk. But lots of these series are very close to a random walk. And the random walk gives you the right intuition about where these things are going to go. It's a random walk with a trend. The data I had a little over 0.5% trend per month. So the random walk with trend gives you the right intuition in terms of your professional investment management or your personal investment management. And you don't necessarily, you're probably making a mistake if you see a security that has gone up, assuming that that trend will continue. You know, my favorite example, one of my favorite examples, take IBM stock from 1950 to 1980. IBM kept going up and up and up and up. Well, then it stopped. And it did not stop for technical reasons. And you could not have covered it. You could not have discovered it for technical reasons. It stopped because of the PC computer, originally with Apple, but others. So these trends, there are trends in the data, but they are driven by fundamentals and not by anything that you can uncover using technical analysis. So my objection to technical analysis is I think that the basis for it, statistical support for it, is incredibly weak. And secondly, it diverts attention from the important issues that investors need to pay attention to. That's my concern.
Bill, do we have a good understanding of why there's excess kurtosis
I'm
in
sorry?
these distributions, why the distribution is not normal? Is there a best explanation for that?
Is there an explanation for it? Gene Fama did his dissertation on this topic. And his dissertation was primarily statistical in nature. And he ran tests on each of the Dow Jones 30 stocks at that time. His dissertation was published probably around, I don't know, 1965 or something. So he was looking at the statistical characteristics. There's a class of, now you're getting me beyond my knowledge of probability theory, but there's a class of distributions that have the characteristic that they all converge to a common distribution, and the normal distribution is one of those. So the reason why many real-world data are well described by normal distribution is that the underlying distributions can be substantially non-normal, but when you add them together, the sum of a bunch of random variables tends to converge to normal. But not all of them do. There are these distributions with the fat tails, and they do not have a defined second moment. And Fama showed that quite clearly in his thesis. Now, why? Why does the world work that way? Well, I don't know that I know. It's because things like diesel engines problems occur, and the scandal there. It's because things like 9/11 occur. It's because the crazy stock market crash, which I guess we still don't completely understand. So these odd events that cannot be characterized as a random variable, these odd events cause the actual distribution of speculative prices to diverge substantially. So when I say substantially, you saw the picture. If I just showed you that picture and didn't comment on it, you might say, oh, it's very close. Well, it's very close, but it's not quite close enough. And the departures are quantitatively significant for investors. So I don't think we know, I don't know of a theory that says why the distribution should look that way.
Other questions from the audience?
First a comment and then a question. If I'm at a fork in the road,
You are.
I see economic theory on the right hand and Tom Dorsey and Ted DeMark on the left hand, it's a no-brainer. I'm going to go with the left hand. Actually, two questions. Is Tom Dorsey still alive?
Yes.
Katie,
Remember, he's a power lifter, so that gave him
Oh.
some longevity. Yes.
wonderful. Katie, could you comment on some of the leading indicators that are good to look at and any that you specifically liked?
You know, for me, the best leading indicator is relative strength. In fact, it's one of the only leading indicators, right? So, and it's not always leading. Sometimes it's often coincident. But it does sometimes give you an early sense of where there might be rotation, and that's invaluable to have a handle on that. And I love it because it's very simple. I rarely ever use line charts. As you can see, I make it as complex as I can for myself, just to try to look smart. And but with the relative strength, it's really very simple. It's a price to price ratio. I don't get too many derivatives away from that with my indicators, and I just simply look at, for example, where those ratios are relative to a moving average, or perhaps lay over the DeMark indicators. And what I find is that, for example, energy, you'll see an uptick in energy sector relative strength versus the broader market before you actually get those real absolute gains. And that when you can find it, it can be very profitable.
Other questions? Was there one in the back? Up front?
occasionally read Value Line, and Value Line has different ways of giving recommendations for stocks, for relative strength, one of which is technical analysis. And over time, they will give measures of their level 1 stocks, 2 stocks, 3 stocks, and measure how it's done. But I've never seen them measure their technical analysis predictions and the results. Do they? Does anybody know if they ever do that? And how do they make those technical analysis predictions? I have no idea.
I don't have any idea either. I've never tracked the Value Line service, so I guess I can't really speak to them. More often than not, with that kind of thing, it's a systematic approach where they've programmed it, so it's not visual, it's not pattern recognition, but rather where is XYZ versus its moving average, something as simple as that. And quite frankly, I don't think that adds a ton of value, especially these days. But yeah, I haven't seen it, so I guess that's all I have to add.
Question in the back.
If we go back in history, since 1926, there are different factors sometimes dominate the stock market, whether it is growth, value, momentum, quality. Have you found there are certain time frame where technical analysis doesn't work, or does it work best when the momentum is the driving force in the market, like it's been over the last 7 years?
Dave Lundgren would certainly say that it works best over those long-term time frames. So I would actually disagree, where I find better luck over the short to intermediate term, but it could just be that we use different tools. Theoretically, it should be somewhat fractal in that, the same setups on a daily work on an hourly. I just haven't done a ton of intraday work to make that comparison, but certainly there are some tools that I really rely on for certain time frames because I have a comfort level with them, and these are visually back tested, not actually back tested, but I find them very helpful. And I'll just give you an example. S&P futures on a 30-minute chart, something that our traders care a whole lot about, arguably way too much. I'll put in an internal chat room and I'll say, we have a DeMark buy signal in the S&P futures pit session. DeMark loves this stuff, take it or leave it, and they get so excited about this, and more often than not, it actually is very, it's good information to have. So I'd say theoretically it should work across any time frame. Those are my preferred ones. I'd say where it doesn't work isn't really a time frame question, but rather where is that kind of headline risk or that sort of gappiness that you can get in certain markets, which is less prevalent, like I said, in the currencies and commodities, more so in stocks, and I would say most so in biotech. So biotech is probably the sector that I have the most trouble with, and because of it, I just say, hey, listen, these are binary events that people are waiting for. I have no insight into that, so let the experts, handle those charts.
Other questions? Second from the back.
I was struck by, I think it was one of your slides said Lowe found that there was the most pattern recognition and technical analysis in NASDAQ stocks.
Yeah, I thought that was
And
interesting.
I was struck by that because
Is that it?
I didn't know whether you have explored that and whether that was because they were momentum type stocks.
I wonder if it's, he published that in 2000. I wonder if there's not something there to that one. So in 2000, and remember, of course, what the market was doing then, and it was so largely just momentum growth stocks just being so explosive, so maybe that was a contributing factor. But I don't know. I just don't know. Do you have any thoughts?
I do want to make a comment about, human beings are looking for patterns all the time in everything we do. Everything we do. I remember, it's a long time ago now, in freshman psychology course, various illusions that were put up, is this circle bigger than this one? And I don't know, I forget how those things are done. But all of you, I think, know about those examples where we can be fooled, where we can see things that aren't really there. we can see things that aren't really there. And I think that's basically the case with technical analysis. We are seeing things that aren't really there. And once we are aware of our tendency to do that, and once we look at the data in a different way, the first differences that I put on the board, once we look at the changes, you make money off changes after all, and you don't see any pattern there. There is no pattern in those percentage changes. There is no pattern there except the ones that identified periods of higher volatility. So there are many things in life where we have to learn to not to pay attention. And here I hope I'm not being too rude, but not to pay attention to some of what looks like a pattern. And I mentioned on the chart with the 10-year T-bill, I thought it was a nice illustration, but you could have drawn a chart the other direction if you had gone from 1960 to 1980. And so there was nothing in technical analysis that would have told you about that reversal. What you needed to know was about Paul Volcker.
Another question in the back?
Thank you. Well, we've got a distinguished former Federal Reserve governor in our midst, so I can't resist asking the question, Dr. Poole, when is the Fed going to raise rates? Whether it's technically analyzed or not.
That's pretty far off this subject, but I'll make a couple comments. First of all, I do not know. Secondly, I think the Federal Reserve is making a mess of its communication on this issue, a total mess. There was no reason for the Fed ever to allow a promise or an expectation or projection, whatever you want to call it, to become embedded in its own communication strategy that it would be by the end of 2015. At the time that projection was made about 3 years ago, that was a long ways away. And I think it was basically a way for Chairman Bernanke to attempt to convince the market that the Fed did not intend to increase rates for a very long time. I've observed over my time in office that the Federal Reserve has often made mistakes because it has put language into the policy statement without adequate regard as to how to exit from that language and how it might end up being misleading under different circumstances. And I could talk to you about many examples like that. And I think this is such a case. We all know that in this dot diagram, if you pay any attention to that, this diagram, it shows when the various participants, FOMC participants, expect the liftoff to occur. The dot that is Janet Yellen's dot is not labeled, but we all know that Janet Yellen's dot is much more important than all the other dots put together. So what Janet Yellen believes is really the core, the key to answering your question. And I'm not quite sure what she believes. At her speech a week after the FOMC meeting, she was pretty adamant. We continue to expect, I forget the exact language, that it will be appropriate to start raising rates by the end of the year. So if you take that speech at face value, and if you think that the Federal Reserve, like any agency or like any person, has some stake in retaining credibility by doing what it says it's going to do, then you would say that the Fed has sort of built in a bias to do it. And therefore, it's going to take evidence contrary not to do it. Are we getting enough evidence not to do it? I can name you things that might well be decisive and would allow the Fed to back out of this, I'll call it commitment, whatever you want to call it. we had a somewhat weak jobs report for September. If we had also weak reports for October and November, and if we had, which now seems to be most likely, a weak first report on third quarter GDP, that would make it easy, relatively easy for the Fed to say, well, the economy is not performing as we had expected, and therefore it would be premature to start to raise rates.
I think we're waiting for the black swan pattern in the dot chart. When we see that, we'll know it's time to go.
That's an important one.
A last question?
Getting back to pattern recognition, I have observed that there are believers on one hand and non-believers on the other hand, and I will follow the believers because they're on their way to the bank. My question is to Katie, do you use Bollinger Bands? And if so, how? Or do you just use standard deviation lines?
I don't, but I know a lot of people that do with some success, and I've just never been able to use them with success. And I think you run the risk of having too many indicators telling you the same thing, and then you pick whichever one is aligned with what your your views are for whatever other reason. So I try to stick to one or two indicators for each of those classes of indicators, being trend following, overbought, oversold, and relative strength. And for trend following, my preference is the MACD indicator and the cloud model, which you can see here. See that shaded area, which is a nice gauge of support and resistance that's very forgiving. Notice it provides like a cushion as opposed to a precise point. And if you think about market psychology, well, there's a whole lot of market participants, right? So rarely ever will it be a precise point. That's why with the 200-day, it's rare that you see something come right down to it and bounce right off of it. It dips below typically. Whether it's the levels being gamed by investors or not, I don't care, but there are a lot of market participants to try to understand. So the cloud model helps me do that. Of course, it is one of those old Japanese models, mind you. It was created a long, long time ago, so long ago that they didn't have computers, and that's why it has that, instead of using moving averages, a smooth look to it, it has that sort of jagged stair-like look, and that's because it uses midpoints of price as opposed to a moving average. But so I use that in the MACD indicator, and I find that that's enough for me. And then for the overbought, oversold indicators, as you've seen, I adhere to the stochastics and the DeMark indicators the most.
Please join me in thanking our panel. Thank you, Katie. Thank you, Bill.
Thank you.
So we have lunch at the bank. It's out the hall and to the left on the bridge.